All right, so this evening we are going to be going through different real estate financing programs. So previous class, we talked about the different types of instruments. So in this class, we're actually going to go into the different types of financing programs. So the things that we're going to be talking about tonight is going to basically be the real estate financing programs in regards to the different concepts that are going to be within the programs themselves. Now, of course, we all know that first one, interest. That's kind of pretty basic, okay? Interest is basically what we call, and they will test you on your test, it is the rent of money, okay? Because of the reason why, say like we said earlier, so Mr. Eugene, you need to borrow some money, so you go to the bank of Miss Davenport. She says, I'll give you $100,000. She's not just going to be nice and say, here's your $100,000, okay? Pay me back whatever you want, all right? I'm sorry, Miss Davenport needs to make money too. So in that situation, she's going to go over there, and she's going to tell you, she's going to say, Mr. Eugene, I will give you $100,000, but I'm going to charge you interest. And the interest is the rent on the money. Because of the fact is, she ends up, she wants to make certain that, see, the concept of this is, if she had $100,000, she might have gone out and bought a house and could have made more money. But instead of her going out and doing that, she's giving that cash away to you, so she should be able to do what? She should, in this situation, be able to make some money off of her money. So, like if you've ever watched Shark Tank, you probably have heard Kevin O'Leary. He always says, when I send my little minions out, I want them to come back with many, many friends, okay? What he's saying is as they end up all going out, he wants to make certain that he gets his money back, okay, plus more. So in this situation, what happens and what occurs is that you're going to, with interest, we're charging you a fee for borrowing our money. Now, I had a very good person that I used to talk to, a good financial advisor that we used to talk a lot about, or talk about this stuff. And one of his key things that he always told me, he says, your best friend is the banks. Your best friends is the banks. Because they'll lend you money, but for very little interest. He says, what other person do you know that you would walk up to and say, hey, can I borrow $200,000 to buy a house, and I only want to pay you back 4%? Okay? Most people, if you walk up to somebody and say, can I borrow $200,000, guess what's going to end up happening? They're going to look at you and they're going to be like, yeah, you can borrow it, but you owe me, $800 or $1 million when you're done. Okay? So in that particular situation is most people don't just voluntarily hand out money. Now, in that same situation, we also, though, want to look at what's called the interest rate factors. Okay? When somebody lends money, when a bank lends money, they want to make certain that that individual has the cash to pay them back. If Mr. Grossman comes in to my office and says, hey, can I borrow $100? And I know that he doesn't have the money in his bank to pay me back, I'm going to be less likely to give him that money. Okay? But if Travis came in and said, hey, Justin, can I borrow $100? And the reason he borrows it is because his money's in his banking account and they're closed until Monday, I'm probably like, yeah, man, here you go, here's $100, because I know he's got the cash, he's good for it. Okay? So when we do these things, one of the key things we want to look at is we got to look at many different factors. We got to look at many different situations, and we got to make certain that the person is actually going to be up to paying back the debt. Okay? So when you're in real estate, this doesn't affect too much you. It affects your buyer. Okay? So when your buyer gets a high interest rate, what does that normally tell you, Mr. Eugene? If I come in and I say, Mr. Eugene, I got a great loan. I went to the Bank of Elizabeth and she gave me a loan, and I ended up, she's giving me 25% interest. That's wonderful, right? I'm getting rooked. What? Okay. The thing is the reason that I'm getting rooked is because that's super high. But if I'm somebody that does not understand finances, I may think that's a wonderful deal. Okay? So in those situations you have to look at different factors. Now, when do you need to know what the interest rate is? When do you need to be aware of what the interest rate is? Well, you need to know it when you're completing the, what's that form? The addendum. Third what?
Oh yeah, third-party financing.
Third-party financing addendum. When you're completing the third-party financing addendum, you have to know the interest rate. You can't just guess. So when I talk to a client, if I'm going out and I'm talking to Mr. Keith, for example, I go and say, hey, Mr. Keith, how you doing, man? Everything good? Da, 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 da. We all have our little conversation. And I say, hey, Mr. Keith, I got a question for you. I need to end up in this situation. You know, I'm trying to get a loan and all, and I need to get approved and all, and I want to put an offer in on this house. Mr. Keith goes, sure, Justin. Let me just fill out a third-party financing. And he just throws wild numbers out there. They're not going to accept it. They're not going to accept it because of the fact is those numbers are not going to be correct. That's why it is imperative, by all means, it's extremely important by all means, that when I talk to Keith, I need to be pre-approved. Okay? Ms. Linda, why is pre-approval such a big deal? Why do we care so much about pre-approval? I talk a bunch about it. What's the big deal?
Basically is we want to make sure that our agents go out there and they are actually being able, their clients will be able to sell that buy a home. If not, it could be costly because you will have some clients will take you to 5, 10, 15, 20 properties and say, I don't want to do it. So you have wasted your time, your gas, everything. But if you have been approved, pre-approved, then you know that you have a serious client.
So
And you know about basically what price range you should be looking at.
Let me ask you this question, Ms. Linda. So Ms. Davenport comes to you and says, I want to buy a house. Okay? She comes to you and says, I want to buy a house, Ms. Linda. And what's the first thing you ask? You say, Ms. Davenport, well, are you approved? Are you pre-approved? And she says, no, I'm not wanting to do all that. I just want to go look at a house, Ms. Linda. What are you going to tell her?
I would just tell her in a nice professional way that our policy here is that we prefer that our clients are pre-approved, and also we also have to have a
So Miss Linda, I'm gonna cut you off there for a minute.
good.
So Miss Linda, Miss Davenport says, I don't give a crap what your policies are. I don't give a crap what your policies are. I just want to go look at a house. What happened?
I would just tell her in a nice way, thank you, but I guess
Still not on it.
I ain't gonna say it. I'm not saying it.
Mr. Travis, what would you tell her?
I ain't saying it.
So Miss
I ain't
Davenport
saying it.
wants to come and look at a house,
You know it.
but she doesn't want to get pre-approved. And Miss Linda told her that policy here in the office.
I'm in swinging arm here.
I know. I'm saying though, but Miss Davenport, Miss Linda has said that she won't show because of office policy. Okay? Miss Davenport told Miss Linda, I don't give a crap about your office policies.
Go ahead, Travis, and I would dodge.
What would you say to Miss Davenport?
You're wasting my time.
Okay, that's one direction. But are you gonna say it like that to her? Are you gonna say you're wasting my time?
No.
No, I'd say, well, I'd probably refer her to a lender that can get her pre-approved if she wants to do that.
So here's how I would handle it. This would be me. So Miss Davenport says, Justin, I don't give a crap about your policies. Okay? And I say, well, Miss Davenport, I completely understand it and I agree with you. Yes, policies can be stupid. But let me explain why that policy is in place. The reason why, Miss Davenport, is if we happen to be out looking at properties, say me and you were walking around, we see a bunch of properties, and while we're looking, you find your dream home. You find that dream home. But here's the thing. That dream home just got on the market today. Just got on the market today. Well, what happens now is that dream home's on the market today, and everybody is wanting to see this home. If you go look at that house and I don't get you pre-approved, I'm doing you a disservice. Because why? Because when you want to put a contract on that house, I can't get you I can't do the contract because I don't have the numbers to fill in what? The third-party financing. And I don't have the rates. So now we found your dream home, but I can't submit an offer because I don't have your stuff. So now I got to wait 24 hours. And if I wait 24 hours, that home's probably what? Long gone.
You better start trying.
Uh-huh. And Mr. Grossman, how quick do these homes go these days?
Lately, within like a day, day and a half, 2 days.
Yeah, quick. So you want to educate your client. You want your client to see that, you know, it's not that I'm trying to be a pain in the neck. I'm not trying to just be another rule follower. What I'm doing is I'm telling you, when we go in, it's kind of like me going over, if you're going to a shooting range. It's kind of like, if we don't get you pre-approved, here's you a gun, Miss Davenport, but I'm keeping all the bullets. What does that do for you? Not anything, okay? Or any other tool. I give you a hammer, but I keep all the nails. There's no point in it, okay? So what you want to do is explain to your client in regards to the reason that we have the interest and the reason we need these rates and we need the interest financing and we need these details, because it's a chance for you to explain to your client. Because if you put it in that way, Miss Linda, if I said it that way to her, do you think Miss Davenport would be more likely to do a pre-approval?
Could be.
Yeah. You have a higher chance because I'm educating my client. That's very key. So when you're talking to your clients, it's extremely important that you don't just assume they know everything. It's your job to educate them, to help them, okay? Now, getting back here. So we talked about interest and interest rate factor. Now we're going to start talking here on interest only. What we're talking in this situation is this. There is at some point, say Mr. Travis and Miss Elizabeth, they want to end up, they want to build a house. Okay, they bought some land at a tax sale, bought it pretty cheap. They built a tiny home on it. They're not expecting to live there long term, just a short term investment. And they want to end up, they just kind of want to build a house and then flip it and make a profit. Okay? Miss Elizabeth, I'm going to ask you a question. Do you end up in that situation, ma'am? Would you want to pay the highest amount monthly for a note for that if you're going to get rid of it eventually? Heck no, right? No. Miss Elizabeth doesn't want to do that. She wants to pay the least amount that's required, just like anybody would. Okay? So what happens is Miss Elizabeth would talk to a lender and tell the lender, I want to do an interest-only loan. What I want to do is I only want to have an interest-only where I'm only paying the interest, not the principal, because my goal is to flip this property. So I don't care about the principal. I just want to pay, what we always call when I have my meetings, we just want to pay for the wristband. We don't want to own the place. We just want to be able to go and use the benefits of it, okay? So in that situation we want to have the wristband, okay, only for the use in regards to the process of where we're at, okay? So again, these are very key in the situation in interest only. Because interest-only loans, now don't be eating all of it. So
You just keep paying attention to your class.
I've got a watch here. I got a mail Miss Leela some.
Y'all, he's a slave driver.
So,
Got put some in the mail, huh?
yeah.
You know, it does bother me. I'm listening to everybody respond with food in their mouth because you know that they're gonna stuff their mouth and answering questions.
What class are we on? I'm paying attention.
Yeah. Oh goodness. But what's coming into this situation is that with interest only, they're utilized mainly for the concept of what? Just for building or flipping. Okay? You're just going to pay interest only. Now, Mr. Travis, I'm going to come back to you. Would it be smart for your wife to stay in a loan interest only for the entirety of the loan? No, because what happens? You're only paying interest. You never hit the principal, and if you never pay the principal, how long are you gonna pay interest? For basically forever, okay? So in that situation, not a wise idea. Interest only is not a wise idea. Now, negative amortization. This is what is basically anything that is not a fixed rate loan. If it is not a 30-year, or 15-year, or 10-year, or 5-year loan, that's the key word, fixed, it is a negative amortization, okay? Because of the fact here is this. Being a negative amortization loan, it means that when you pay your last payment, Mr. Eugene, you go in and you pay Mr. Jacob your last payment, and you're in an interest-only loan or an adjustable rate mortgage, guess what? Mr. Jacob, when you pay him, you may not be zeroed out with him if you're not in a fixed rate loan. So you pay off what you think all of it, and Mr. Jacob sends you a $15,000 note for the remainder that you still owe. Okay? So a fixed rate note, fixed rate loan, is basically the only true fully amortized loan. Everything else is negative. Okay? So when we talk about ARMs, we talk about interest only, we talk about all these different types of loans tonight, what's going to happen is if it is not a fixed rate loan, it don't count. Okay? It doesn't count. Now, we do have what's called buy down plans and points. Now, you'll notice this, and this is very big to your clients. Very big to your clients. Buy down points and basically plans is where you can end up buying down your interest. So if Miss Elizabeth, if I was to quote you, and I'm a lender, I quote you, say 5%. I could tell you, Miss Elizabeth, if you ended up, if you were to pay me, say, $5,000 at closing, I'll drop your interest rate from 5 to 4%. But you're paying me up front to bring down your loan, your percentage. Now, I always get this question from everybody. Well, can I just go bring you $20,000 and you don't charge any interest? Okay. Unfortunately, there's a limit. Okay. You can't buy down to 0. You can only normally buy down 1 to some 1.5, but you're only limited to go down to a certain amount. Okay. Now, like I said, amortization, we'll talk about that as we continue, but it's basically, it's the percentage, like if you make your payments, when you do a mortgage, you've done a mortgage recently, what happens is it's probably about 50 pages, but it shows you the amount of the interest and amount going to principal. And it goes all the way down, and it shows how long you're going to pay and how it's going to be split out. Now, my question, Mr. Garrett, for you, I would like, if you can turn on your mic for a second, Mr. Garrett. Do you think, sir, that when you're making payments, when you get a mortgage, are you paying off your principal in the beginning, or are you paying your interest in the beginning?
The principal.
Okay, Miss Leila, do you agree with him on that?
Honestly, I was thinking the interest.
You're right. Miss Leila's right on this, Mr. Garrett. The reason she's right is if you pay down your principal, there's nothing to what? There's nothing to charge interest on. So in that situation, Miss Leila is 100% correct, because what happens is that if we were to pay down our principal and we pay it to 0 and we pay it in the first 10 years, what do we pay for the rest of the 20? So normally in the beginning, you're going to pay about 90% interest, 10% principal. And then when you get, if you're in a 30-year loan, by the time you're about 20 years in, now you're starting to pay a bigger chunk to your principal. Okay? And the reason they do that is the fact of the matter is that if we pay off principal early, then, what do we have to charge interest on? Now,
I do have a question.
Yes, ma'am. Yes, ma'am.
So if someone, let's say they're trying to, I'm assuming with you're describing the buy down kind of situation where they could maybe pay twice, like say they pay their mortgage and then turn around and pay on the principal. Are they able to do that?
That's a very good question. So you'd have to talk to your lender. Some lenders do allow it. Some lenders don't. Some lenders will tell you that if you pay, like my mother, she always pays a payment plus another payment. In her loan, they only allow her to pay that extra payment directly to interest only. They won't allow her to pay it to principal.
Oh,
But I
wow.
have heard, Ms. Leela, that there are some banks that will allow you, if you designate it on your check, principal, they will allow you to apply it to principal. But you would have to check with your individual bank, if that makes sense.
Okay, I understand.
Okay? But yes, that's a very good question, because if you can pay down your principal quicker, you want to jump. You want to jump over there and be writing as much as you can. Okay? So in these situations, we want to make certain that as we're doing these, you want to be in communication with your bank and make certain that they're applying. Now, I will tell you, if a bank does not know, say that Ms. Leela does go, Ms. Davenport, you're her lender, and she pays you, but she does not designate on her check that this is principal, then you under law are allowed to put it to interest only. So you could just basically take her payment, put it into interest only, and you're pretty much set. You're basically still keeping the money. But if she puts principal and your policy and your note with her agree to it, and she says principal, then you must put it to her principal. Okay? But again, it's the individual banks and their individual policies, if that makes sense. But very good question, because that's always asked a lot of times. All right, next one. Let me come over here real quick. All right, so next one we have is real estate financing programs in regards to I equals PRT. Okay, now what we're talking about in this situation is we're talking about in regards to your term versus your amortized loans. Okay, what I'm saying is regards to term loan and amortized loans. Term loans are what we call a certain period of time. Okay, so what happens is that, say for example, in regards to the interest only, okay, Mr. Eugene, you go over and you borrow some money from Mr. Travis, okay, so you borrowed some cash from him and he puts you in a term loan for 10 years, okay, so you go over here, you put the money in for 10 years, and what ends up happening in this situation is you have now turned around and you have this term loan period, okay. What in this particular situation, actually give me just a second, please, madams and gentlemen.
That's it for the day.
Sorry, I had to take it, or had to let somebody know to take a call for me real quick. So in that situation, if you're dealing with term, Mr. Eugene, you borrow that term or that period, okay? You have to pay back that loan within a certain period of time. Now, a term loan is going to be very, basically extremely expensive in the long run, but they're actually cheap in the beginning run. Does that make sense? Okay? Because with an interest-only loan, you're only paying interest for a majority of the loan. And then at the end of the loan, sometimes towards, not always the last payment, but towards the end in a interest only, you're going to pay probably 80 or 90% of the principal as your last payments. Okay? So Mr. Travis is going to make a ton of money on interest, and then at the end get his principal back. Now in a balloon payment's the same concept. What happens is it blows up, if that makes sense. Okay? So in this particular situation is in a term loan, you're going to have a balloon payment. What I mean by this is in this situation is that Mr. Eugene, if you're in a balloon payment, you're making interest only payment, interest only payment, interest only payment, and your very last payment is your full principal. Okay? So if you borrow $200,000, your last payment is going to end up being basically your $200,000 payment. Okay? We good?
Good.
All right. So they got it?
Good.
Awesome. Now, in regards to amortized loan, okay, these are going to be equal payments. Okay? These are going to end up being equal payments. You make payments over the loan, and then what happens is you have principal and interest. So if you have a note, say in this situation, say Mr. Jacob, he has a note, he's paying his note. If he is in a fully amortized loan, he's going to make equal payments to principal and interest every single month. Okay? And when he pays his last payment, guess what happens? His loan dies and it's over. Okay? So when he makes his very last payment, loan's dead, and Mr. Jacob gets a release, and he now is the owner of the property. Okay? But again, you will have the difference between term and amortized loans. These are very key and very important. Okay? So the ones on the left, if you are taking notes, the ones on the left, bad. Okay? The one on the right, you want to put good. Okay? Now, when is it beneficial to have your client go in, Mr. Colton, when do you think is a beneficial time, sir, for you to put a client in term loans? What would be an example, sir? I might have lost him. Yeah. Then I'm going to go to Mr. Keith. Mr. Keith, when is an example in regards to the term loans?
I would say a term loan would be good.
Remember I told you earlier, Mr. Keith? Let's see here. Do you remember earlier when I told you, Mr. Keith, about Miss Elizabeth wanting to flip her property? Remember that part?
Yes, sir.
All right. What if, say that you want to build? Would that be a prime time to use a term loan? You're in construction?
Yeah.
Uh-huh. Because do you want to pay a large payment while you're building the house?
No, not at all.
No. Because if we build a house, you probably want to put all your money you saved into the accessories of the house and pay limited on your interest. So
yes, sir.
That is very good. So, and it's a trick question, Keith, and I didn't think anybody would probably catch that right off the bat. But yes, in that situation is a term loan is beneficial if a person is trying to flip a home, if they're trying to build a home, or if they're trying to end up in a situation that they're trying to maybe refinance because they lost a job. Okay? If, Mr. Grossman, you're paying your payments each month and your payment was $2,000 a month, and then all of a sudden, boom, you lose your money. Everything, you lost your job. Well, if he's got $10,000 saved, he may want to refinance and pay very little interest so he can keep his house versus going over and losing his house in 3 or 4 months. Okay? So
I have a question.
Yes, ma'am.
I'm sorry.
Yeah,
Are you able to go from a term to an MRI?
yes, ma'am.
You know what I'm saying?
Yes, ma'am. Yes, ma'am, you can. And you can go back and forth. You can jump between them. It happens a lot. Now, I will tell you, the only drawback to it, Miss Leila, is the fact of the matter is that if you jump back and forth, you're going to create, or you got to pay loan origination fees. So every time you redo a contract, you're having to pay more money, if you see what I'm saying.
Okay.
I'll give you a prime example, okay? And this actually happened way back when I first got my real estate license. My mom's probably going to laugh in regards to remembering this one. But a lot of times my agents always think that they get the worst client in the world. They have the worst client, worst luck in the world. My very first client I had, I think it was my sister, told me about this lady that worked at the church that my sister worked at. Okay. And she had, this poor lady she had breast cancer. She ended up had breast cancer and was about to lose her house. Was about to lose her house because she had breast cancer, was not able to work, ended up, she was trying to make ends meet, was about to lose her house. Now she had been in a fully amortized loan. Okay. And so I ended up, it was a trailer house is what she had. She did not, the land was paid, but it was the trailer house. And so in that particular situation, while she would have paid all the payments, I think she was 15 years, 20 years, somewhere in there. Had she paid them all, she would have owned that trailer house. Well, she had lived in that house, what would you say, Miss Linda, about 10 years already, 15 years. She had lived in it for a while. And so what ended up happening was she had lived in it for a very long time. And so the house had already had issues and all. So she ended up, she didn't want to just let the house go back. And when I talked to the lender, well, the lender didn't want it back because, you know, a trailer house doesn't hold value. So what we ended up doing was we put her into a term loan. So we took her out of amortized, put her into a term loan. And the reason that we did this was, number one, we were able to stretch the term loan into what was called a balloon payment loan, is what we did, where she pays only $300 a month. She is paying, I think, close to $1,250 or something, maybe a little bit more. She couldn't afford that. Okay, so we put her into a term loan, balloon payment, and she only had to pay interest, $300 a month, and they put her in a 30-year note. The thing is her health, it was basically dwindling, okay? And it was the hardest transaction I ever had to deal with. I had even the hardest conversation. I had to sit down with her at the local restaurant one day to sign all the paperwork with her, and I had to look at her and I said, you know, this is the hardest conversation I've ever had to have with somebody. And I said, we're doing this, and I want to explain why we're setting you in this situation. Your age plus the condition you're in, your doctor's already said you got about 15 years max. That's it. Okay. We're putting you in this 30-year in hopes that you're going to pass away prior to it, so that when you pass, there is no children or grandchildren that are living with you, then they can just come repo it from the estate and you're fine. But you'll always have your house. You're not going to go homeless. We're not going to have you on the streets. So I talked to her. She had talked to an attorney. We all came to an agreement, and she signed. Well, this lady's still alive, and that was probably 10 years ago. So, and from what I've heard, she's still going. She's still kicking. So the thing, though, is in that situation is she had exhausted her. So normally the last case scenario that they're ever going to put you in is a bullet. That's like the very, very last one. If she passes away, then she'll lose her house and things like that, but she's not going to be homeless. You know, she's not going to be without a home. But with the balloon payment, once you're already here, it's very difficult in her situation, to go back to amortized because she doesn't have the funds. There's no way she could jump back over here. But yes, there are some people that might happen to come into a lot of money. And if they come into a lot of money, then they might want to jump back over here. But a lot of times where you see people jumping from amortized to term is when they're either about to move out. Say, Miss Elizabeth, you and Travis, or say y'all own a house and y'all want to take some equity and fix up the house and then want to sell it. Well, in that situation, then it would be smart to jump out of this and jump over here, take that equity, and then go over there, fix up the house and sell it, okay? But if you're in a situation, if a client, say for example, I had this happen before, a client ends up, they are in a amortized, and they just wanted to jump over here because they just wanted their payments to be less. No reason, no justification. They just wanted to, I want to jump over here and pay less money. Well, the problem is people, they look at it from this situation. Oh, I'm going to pay, you know, $500 cheaper here when I've been paying $500 more here. I can take that $500 and go buy me a brand new car. Okay? Well, what happens they don't understand is when you jump out of here and you jump over here, you're immediately jumping to negative amortization. It's going to be negative when you pay your last payment. And oftentimes when you jump to term, a lot of times what's going to end up happening, and it's sad to say this, but a lot of times when you jump over to term, guess what ends up happening? It's very difficult for them to jump back to fully amortized. Okay? And so most of the time, once you jump, sometimes you have to sell that property. But again, it's not something that I just recommend. Like if a client comes in and says, I found out online that I can save, you know, some interest if I jump to an ARM, I'm immediately like, no, don't you dare do an ARM, okay? Because it puts you in a situation where, yeah, you pay low in the beginning, but guess what they start doing? Interest starts doing what, Miss Linda, if you're in an ARM? Do you go up or down? What do you think? It's going to go up. Why is it going to go up? Because it's going to do what the market's doing. So it's going to go up, and 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 it's going to go up. Okay? So in that situation is, you want to be very careful. And sometimes this interest rate is going to go way higher than what this is. Okay? So again, you got to be very careful with that. Now, leading that to what we've been talking about, you have your fixed rate. Okay? Your fixed rate, like I said, is the best of the best, the highest. This is what you want to put your client in. In my office and myself personally, if a lender ever approves my client for bullets 2, 3, 4, or 5, these bottom ones here, I immediately, if Miss Davenport was a lender and she qualified you, Miss Linda, for an ARM, my first thing I'm going to tell you is, Miss Linda, why are you getting pre-approved for an ARM? What's your purpose? Give me your reason. Well, I just thought it'd be cool. I can pay low interest right now. Everybody else is getting 3%. I can get it at 1.9. That's what Miss Davenport can get me at. Okay, I understand that. But how long are you going to stay in the house? Well, I'm going to stay in the house 30 years. No, you do not need to be in an ARM. You need to be in a fixed rate.
Right.
Now, Miss Davenport's going to shoot me for telling that because she probably makes more money if you're in an ARM. But, Mr. Travis, is our duty as agents, is it our duty to look out for myself or for Miss Davenport?
If you get a cut.
If I get a cut, yeah. Yeah. Unfortunately, no. You cannot look out for yourself or for the other person. Your duty is, your fiduciary duty is to Miss Linda, which is my client. So Miss Linda is the one that I have to tell. Now, I've had this happen before. I have had agents that have gone over, and can y'all still hear me online? All of a sudden, something just popped up here.
Yes.
Perfect. So in the situation is, in that particular area, like I said, is if we go there, I've had lenders that have contacted me, and lenders have told me, said, why in the world are you doing that? Why did you tell her that? You need to shut up. You need to keep your mouth shut. Stay on your side of the line, basically. Okay? So, yeah. So in that situation is, you need to stay on your line. No, I don't, because it's my duty, Miss Linda, when you hire me, do you want me looking out for myself and Miss Davenport, or do you want me looking out for your interest?
You better look out for me if you know what's good for me.
That's right. I better look out for you. We'll probably have Miss Leela come after me and beat me if I don't look out
That's
for you, right?
Not Darren, better.
Yeah. So in that situation is, yes, you have to make certain that you're looking out for your clients. Okay. So the bottom 3, they're not bad. I don't want people to get that assumption that, oh, Justin just doesn't like those. No, it's not that. It's the fact of the matter is, you want to make certain that you're looking out for your client's interest. If Miss Linda, you come to me and you say, well, Miss Davenport put me into an ARM, and the reason she did it is because I'm only going to use the property or stay in the property 2 years, and she said this is my best option because I paid the lease. Okay, I'm fine with that. Wonderful. You've been advised. But if you come in and say, well, I just want to save money, I'm going to sit down and I'm going to run some numbers and I'm going to say, you're really not saving any money. You're spending a lot more down the road. Okay. So in these situations, the best of the best is your fixed rate. Okay. Your fixed rate, of course, is going to have what's called your impound or your escrow. And in the escrow, you're going to put what in it, Miss Linda? You make payments. What are you going to put in your escrow?
Taxes.
Taxes and what else?
Insurance.
Why do you put that in an escrow account? Why don't you just pay that at the end of the year?
Well, on ours is because we pay it out monthly. In other words,
I understand, but my question still is this. Why do we need you paying money to the lender, to Miss Davenport? Why are you paying Miss Davenport your property taxes and insurance when taxes are only done once a year? Why does she need that money?
well,
Miss Davenport has what on, what's your property, Miss Davenport? What?
I can't think of it.
Collateral.
Yeah, collateral. Yeah.
So that property's collateral to Miss Davenport. You don't pay, she wants that house, so she can go sell it to somebody else and make her money.
Yes.
Okay? Well, what if you don't pay your taxes, Miss Linda?
Well, you can lose your house because of that.
Oh, and if you lose your house, what happens to Miss Davenport's, to her collateral? You just stop it. She loses it. Is she gonna be happy with you?
No.
Not by any means. She's gonna be furious. Okay?
And you have insurance because God forbid your house burns down, etc.
That's right. We have insurance. So Miss Davenport wants to make certain what?
She's covered.
That she is covered and that her asset is going to be covered when if you don't take care of it, she's taking care of it.
That's right.
Okay? So in that situation is a fixed rate is an all-around coverage for both, even though the borrowers don't see this, it's coverage for the lender and for the borrower. It covers both of them. Okay? Now here's the only flaw with it. Is do you think banks are prompt, Mr. Travis, in regards to knowing that Miss Linda still has coverage, insurance coverage on it? Think about it. Do you think they're quick on the draw? No. They're slow. If Miss Davenport's in a business to do banking, she probably has how many clients, Mr. Christoph?
More than Sunday.
Yeah, tons, right?
Yeah.
Miss Davenport's probably got hundreds of thousands of clients. Miss Davenport, I'm going to ask you, you used to work in kind of an area that deals with a ton of people. Was it possible for one person to know everything? No, it's too much. It's too much. So in that situation, what happens is that oftentimes, and this has happened before, Miss Linda happens to not pay her full note to Miss Davenport. She just pays her taxes and she pays her, basically, her principal and interest. Okay? Well, if you pay those things, Miss Linda, but you didn't pay your insurance, what happens to your insurance when you don't pay your insurance?
Well, they'll notify her.
Well, yeah, they're going to notify her, but what happens to coverage? If you don't pay, what happens, Mr. Eugene?
Oh,
It's lapsed.
yeah.
It's lapsed. And if it's lapsed, and then the house burns down during the lapse period, what happens? Does the insurance cover it?
No.
No, and now what's happened?
You're responsible for that.
Not only you, but also Miss Davenport. Do you see what I'm saying? Y'all can go on in. So in that situation it's very good that we make certain that all of those are taken care of. Do you see what I'm saying? So in that situation is we want to make certain that as we're doing these different things, that we want to make certain that we are keeping everything up to date. I had a client one time that I was dealing with, and they were paying their stuff, but they didn't keep their insurance active. When they end up in that situation, they don't pay. What happens is if something happens to that property, it's not covered. Okay? So in that situation, you can have big issues. Now, of course, like I said, we talked about adjustable rate mortgage, guaranteed payment mortgage, home equity. Now, this one I hate. This one. Home equity and HELOC. I hate them. That's just me. So I've worked in the legal field. I've worked in doing financing. I've worked in many different areas. And I'm going to tell you, the biggest thing homeowners make mistakes on is this last one. Or not the last one, second to last one. This, I never, when I try to talk to people, it just blows my mind. Blows my mind. So I talked to, say, Mr. Travis and Mr. Travis and Mr. and Miss Stahl. Talk to both of them. There we go. Cover it that way. Talk to Mr. and Miss Stahl, and I tell Mr. and Miss Stahl, I say, why are you here today seeking, credit counseling from me today? And they say, well, the reason that I'm seeking counseling is because the fact is we have $50,000 in credit card debt. We have a house, but we have $50,000 in equity. So what we're going to do is we're going to take $50,000 in equity of our house, pay off our credit cards, and then guess what ends up happening? It's a win-win for us. We pay our credit cards off and we'll just pay our mortgage.
No, it don't work that.
What's the problem with that?
Because most of the time, if you get that amount of money, eventually you're gonna go ahead and you're gonna keep on going with credit. You could also lose your home too.
That's the key thing right there.
Because of the fact you're putting your home up.
What has happened is you have taken, and this is a completely different course, and I'm not going into all that with y'all, but what you've just done is you've taken a secured debt. When I'm talking about secured, it means it's got collateral. Took a secured debt to pay off unsecured credit cards. If you go rack up, say Mr. Travis, you went with your credit card and you racked up $50,000 in credit card debt, you might have, did you borrow Miss Linda's card? I was just wondering.
Yeah.
Okay.
No.
But in the situation is, you go rack up 50,000 in credit card debt. You might have bought some stuff, right? He might have bought some, say, who knows? You might have bought computers, you might have bought TVs, whatever. But the thing is are those items attached to anything? No, because they're unsecured. I tell clients all the time is, if your credit's already crap, let it be crap. Just let them sue you, do what you got to do, come to a settlement, but you don't ever, ever, ever take your equity out of your house. If you take your equity out of your house, guess what ends up happening? You ended up in that particular situation. When you pull that equity, you have now just put yourself back to square one, and now, God forbid, if y'all lose your job, what happens? You lost your home. Okay? So by all means, I tell people this all the time, is you want to make certain by all means that the home equity loan is only used as an extremely last resort. Did y'all hear me? Extremely last resort. There should not be any reason. It needs to be at the very end. Now they do have a reverse annuity mortgage, and these can be, yes, Ms. Linda.
I don't mean to change the subject, but home equity too, if you ever want to buy another home, you have to pay that note off to them people too.
You have to, there's a lot of stipulations. There's a lot of stipulations with home equity loans.
So it could affect your, the
That's
the
correct.
amount that you want to purchase.
That is correct. That's why one thing I highly do not recommend is when a client comes to me and says, well, I'm going to take a home equity line of credit, I immediately say, why? What's your point? What are you doing? Now, it's one thing, I will say this. If Mr. Eugene happened to have, say he has a $300,000 house, and he's got $100,000 in equity, and he comes to me and says, I want to take a home equity line of credit out so I can purchase another house to have passive income, I may be okay with that. Not just because I'm a real estate broker, but from a financial standpoint, that's pretty good. Because the fact is you are taking that money to do what? To make more money, okay? But if you're taking that money out to pay off credit card debts or to put a pool in your backyard, I've had that before. No. That's not what you need a home equity for, period, okay? That is not what it is for. You do not need a pool to utilize your home equity, okay? Now, another thing is, like I said, you have graduated. When you see the word graduate, if you want to put a dash and put steps, it basically steps up, okay? It's like a staircase. You pay for a certain period of time, then the interest goes up, you pay more. And it goes up, and it goes up, and it goes up. And it's like a staircase. An adjustable rate mortgage, okay? This are not adjustable, a reverse annuity mortgage. This is often used for those individuals that are 65 and over, okay? They basically end up, they are reversing mortgage, and they're ending up basically, they're getting payments, not so much payments, but they're getting money in the benefit of them basically having equity in their house and they're getting paid back, okay? This is also a last resort, okay? It is often utilized for individuals that are single, like say it's a mother that's the last one, okay? The kids have houses and all, the mom's living in a house by themselves, they have equity in it, and they don't have a job and they need money for, medical issues. Reverse mortgage might be beneficial for them, okay? But again, your client still needs to be advised. Now, Mr. Grossman, question for you. Does this mean, just because I told you all this stuff, does this mean, Mr. Grossman, that you should go out and advise, if Ms. Davenport was your client, should you go in and advise her about which one she needs to use?
That's not your job.
That's not your job, okay? You can give Ms. Davenport a overview of these, but what should you end up telling her?
The lender or attorney will tell her.
Your lender or your attorney would give you the correct advice, okay? You need to talk to a licensed professional. I'm a real estate agent, so what do? I sell houses. That's my job. Just because I have a license does not mean that I'm licensed in everything. I'm licensed in one thing, and that's to sell. Okay, and that's very key. Now, of course, we're going to go in regards to, like we talked here, we're going to talk about these as we move forward. In regards to an adjustable rate mortgage, it's an ARM, and they often will refer to it on the exam as an ARM. And we're not talking about an ARM, we're talking about an adjustable rate mortgage. Okay, so there's adjustment periods. And what happens is you have an initial rate, a note rate, and then your qualifying rate. Okay, so what happens is I want to get Mr. Travis in a good deal, and I want him to end up using me. So I tell Mr. Travis, hey, Mr. Travis, I can get you into a mortgage for 1.5% interest. You want to come on, man? Come on in here. And he comes on in, and so it's kind of, I always tell people, put it down to your terms here. It's kind of like, I throw that hook out there and I'm reeling them in. Okay, I got that bait on there and I'm just reeling you in. Okay, so I'm reeling you in, and once I get you in, get you sign all the paperwork, you find out while we're looking at the note that we find out that interest rate's only good for 2 years. So for your first 2 years, 1.5. Your next year, after that time, we're jumping it to 5%. And then within 5 years, we're jumping it to 10%. So what happens is we end up, a lot of times they use these initial rates to suck you in, and get you in. Let me pull him in here. Now once I got him in here, now guess what? Now once I pulled him in, I'm going to now get him to sign and then end up seal the deal. Okay? But what happens is that he gets hit. And this is where it happens a lot. In real estate, it's sad to say, but there are a lot of times that people come in and they get in these ARMs and their payments for the first 2 years, maybe $750. Not bad, right? They're like, heck yeah, I'm set. Got this beautiful house for $750. The next thing you know, 24 months later, that's when the price shock comes in, and guess what? That's 24 months you paid $750, now $2,500. And then you end up, wait 5 years, and now you get $3,000 or $3,500. Okay? Yeah, you want to refinance. That's when you call who? Travis, you call Mr. Jake, right? Immediately.
Jake.
Yeah, you call Jake, and you're like, hey, help me, man. Okay?
Jake the tater tot man.
Yeah, Jake the tater tot man. So in that situation is, you have to make certain that your clients are aware of these things. Now there are, don't get me wrong, there are index and there are margins that they run off of, okay, that they do look at, okay? Now, the thing is that your rate is actually capped, though. And when I'm talking about capped is, I'm saying in this situation, is that when we're discussing caps, the cap ends up is the max that they can go. So if Ms. Davenport, you were the lender and you're lending money out, the government does say that you cannot, in that situation, you can't shoot crazy numbers. So you can't start off at 1.5% interest and shoot up to 42%. You can't, there can't be that big of a gap. So they do require that there is basically a cap that's put on where they can't end up, they can't basically be what's called usury. They're taking advantage of you. Now, there is oftentimes in ARMs, though, there's prepayment penalty. And why do you think that they end up having prepayment penalty? Why do they put it in an ARM? Well, here's the reason. They don't want Mr. Stephan back there to make payments of $750 for 2 years and then pay off the loan. Because what happens is if Ms. Davenport wrote that loan, she probably took the money that she is supposed to make off of Mr. Grossman to lend to other people. And what's ended up happening is that Mr. Grossman pays off during that prime area. Guess what happens? She doesn't have the money to do what? To go over there to fund those other loans. Okay? Now, they also can be convertible, meaning that they can be converted into different types of loans. So in this situation, there can be these areas where they are going to end up being converted into a different type of loan. Okay, we'll talk about that as we progress. Now, one of the key things here about loan products, okay? Remember we talked earlier in this class about selling off loans, okay? Which market do you go to borrow money, Mr. Eugene? Primary or secondary?
Primary.
Why do you get that at the primary? Because that's where the banks are, right? Yeah, like I said earlier, do you end up calling the president and saying, hey, I need to borrow some money? No, you don't do that.
Does it work?
No, it don't work, unfortunately. If it ever works for you, let me know, okay? Ms. Davenport and I will be more than happy to make some phone calls. So in that situation, what happens is the loan products have to conform to the standards that are there. So what I'm saying in this particular situation is we've got to make certain that these loans actually meet the requirements for them to be bought. So in this situation, Mr. Keith goes down to the bank of Mr. Eugene, and Mr. Eugene, he comes to you and he says, I need to borrow some money. I'm going to borrow enough for a house. And Mr. Eugene, are you just going to give him money? You
Well,
just say,
no,
here is
I'm
Keith.
gonna check him out first.
Why do you want to check him out?
If he can't afford to pay for it, I'm not gonna give him money, and I ain't got no money to give anybody else.
So in that situation, you want to make sure he's good for his cash.
That's right.
Okay? So that's the first one. That's the initial one. What's the second thing that you're worried about? Do you want to hold that debt the entire time that Keith's paying you?
No, I wanna sell it off secondary.
You want to sell it off to somebody else so you get more money to do what?
Right, so I
Lend
can-
more money,
That's right.
right? So the initial thing is that we're doing this in the situation that we want to make certain that, number one, can this client, in this situation, Mr. Keith, can Mr. Keith pay the loan? Can he afford the loan? That's the first question. The second question comes into, does this loan meet what's here on the slide? Does he, in this situation, is his PITI at least going to equal about 28% of his monthly income? And remember, your PITI is going to be your principal, your interest, your taxes, and your insurance. So does it equal at least, no more, we don't want it more, does it equal up to 28% of his monthly? So we're letting Mr. Keith end up in this situation, just his principal, interest, taxes, and insurance, as long as it is no more than 28%, he's conforming. If with his PITI plus his debt equals no more than 36% of his monthly income, we're good. Okay. Now, if the borrower has good credit, if Mr. Keith has good credit, and oftentimes good credit, people always ask me this, what's good credit? Good credit's about 680 credit score. Okay, you're about 680, you can classify as good credit. And if Mr. Keith has stable employment, then Mr. Keith's loan is classified as conforming, and Mr. Keith is allowed, you can lend him the money, and you'll be able to sell that off to the secondary market. Okay? Now, the maximum loan limits are going to be set, however, by FHFA. Okay? So the maximum loan limits that you can have are going to be set by the FHFA. And these loan limits basically vary. They're not always going to be consistent. They're going to vary. Okay? Now, sometimes, however, Mr. Travis probably knows what I'm talking about now. Sometimes what can end up happening is a client may not meet or be within these maximum loan spots. He had a client that was dealing with that before. So in that situation, they may not fall within this maximum, but they meet all of these elements up here. Okay? If that happens, that person has to go into a jumbo loan. Okay? That individual has to go into a jumbo loan, and it's very difficult, we'll say right now, to get them approved. Okay? Because jumbo loans oftentimes are for people that are trying to get $1 million houses. Okay? So when we're dealing with that, it's very, like, if the economy's strong, it's easy to get them approved. If the economy's crap, it's very difficult. Okay. Again, the underwriter has flexibility when applying these guidelines up here. So the underwriter is truthfully the one that gets to do what? They get to make the decision. Yeah. Now here's my question, Mr. Eugene. If you are a agent and Miss Elizabeth is an underwriter, how often do you and Miss Elizabeth have discussions? How often do you think? Y'all talk a lot? Do you think so?
Maybe not.
Miss Linda, what do you think? Do you think Mr. Eugene talks to Miss Elizabeth a lot if he's an agent?
If he's an agent,
He's a real estate agent.
no.
How often do you think they get to talk?
They probably, to be honest,
Yep,
probably don't even know each other.
that's right. Miss Elizabeth cannot have any influence whatsoever as an underwriter. Meaning, Mr. Eugene cannot walk into her office, and first off, you wouldn't even know she's your person, by the way, unless she happens to send an email out. But if you found out that she was the person and you go over and you were say, I'm going to go buy you some coffee, or I'm going to go buy you your favorite restaurant, or I'm going to do, you do that stuff, guess what ends up happening? You have now might not only jeopardize that transaction, but you also might have lost your real estate license. You cannot convince Miss Elizabeth with presence because you're trying to get a loan done. Does that make sense? Miss Elizabeth has to stay neutral. She is the one that makes the rules. And if you like them or you don't like them, that's not your problem. That's her job, is to make certain that it meets these guidelines. Because here's the thing, coming back to why it's so important. If Miss Davenport's the owner of the bank and she hired Miss Elizabeth as the underwriter, Miss Davenport, how do you feel, ma'am, if you're finding out that your person that's supposed to look out for your interest is over here getting persuaded by other agents and you might be losing money? You gonna be happy? No, she's gonna be furious because you're jeopardizing the money for the bank. Okay, so in that situation, we have to make certain that everybody's staying neutral. Okay, I have a lot of agents sometimes I'll say, hey, you think we can get a hold of that person? No, you cannot get a hold of that person because that person is going to end up, you can get, not only lose that transaction, but you can cause yourself to lose your license. Now, what's this private mortgage insurance? I get a lot of people that end up, they say, well, private mortgage insurance, that must be something about if I don't pay my mortgage, you know, the insurance company gives me some money. Nope. Private insurance has nothing to do, Mr. Eugene, with you. Okay? It deals with the lender. So you went to Miss Leela to borrow some money, okay?
Oh,
And Miss Leela gave you $200,000, all right? And so she goes over and gets you $200,000, and you didn't put down 20%. You only put the bare minimum 3.5%. So Miss Leela gives you your loan. She's going to tack on private mortgage insurance. Yes, she is. And guess who's protected? Not you.
Not me.
It protects Miss Leela. It says protects the lender in the case of default. So if you default, guess what? Miss Leela's getting her money. Okay? She's getting her money. But guess who gets to pay that premium and that deductible, or not deductible, the premium every year?
Me?
You do. It's in your payment.
Yeah.
Okay? So it basically is in addition to principal, interest, taxes, and insurance. So it's in addition to the already PITI, and it stays on, Mr. Eugene, until you have reached at least 20% equity in your house.
Then you can drop it.
Then you have to contact Miss Leela and ask her to drop it. Okay? So the termination of the PMI comes off if you call Miss Leela at 20% and ask her to drop it. But it's, I think, 36%, it automatically falls off. So you have to call Miss Leela at 20% to ask her to drop it. But if you don't, I think it's 36 or 32, it's somewhere in the 30s, it falls off.
I have a question.
Yes, ma'am.
how would a homeowner even know to do that? Is that something that we share with them and they contact the lender?
Yes, ma'am. That's what your real estate agent. That's one of the key things as a real estate agent. You want to keep in contact with your client. Because a lot of times after a transaction's done and they're represented the buyer, the agent just disappears.
Right.
But that prime opportunity for you to be contacting your client within about 12 months and saying, hi, Miss Linda, this is Justin, and I just ended up, I noticed that it's been 12 months since you lived in your house. Do you happen to know if you have met the PMI requirements to have it dropped? There's a prime opportunity for you to jump in and get back to your client and talk to them. But unfortunately, a lot of people, after they sell a house, they're up and gone, and you never hear them. They're like, deuce, I'm out, okay? So in that situation, yes, Ms. Leila, that is a prime opportunity to contact your clients, because a lot of clients don't know that. A lot of clients think, well, I pay 20%, why am I still paying $100 a month? Because it's normally about $100 a month. The reason why is because they've not contacted their lender. So, and that's another reason, main reason, that you want to have good rapport with your lenders. Because what you can do is some lenders, if they use the loan, say Mr. Travis, say that you helped Miss Leila find a house, and Miss Leila, you're good rapport with Jake, you can ask Jake, hey Jake, can you send me a list of my clients when they've hit 20% in their stuff so I can reach out to my clients? Do you see kind of how that works? And then you could contact Miss Leila and say, hey, how's it going? What can I do? You need anything? By the way, you've reached 20%. You need to call Jake so that you can get that $100 dropped and drop your payment by $100. Does that make sense, Miss Leila?
Yes, thank you.
You're welcome. Miss Linda.
When we purchased our home,
Uh-huh.
our lender still today calls us
Yep.
every year and tells us what the interest rates are.
Yep.
What we qualify if we are interested in refinancing our home.
Yep.
He just touch bases once a year for us. And even we say we're fine or whatever, he still does it.
Yep. And that is a good lender. But unfortunately, do you think all lenders are like that?
No.
Unfortunately not. Unfortunately, they don't. So in that situation, that's where you as a real estate agent should be the one that jumps in and calls them. And one of the main marketing leads that a lot of people don't think about is, see, I used to a long, long time ago, when I used to do a lot of marketing and all for myself, what I used to do is I used to actually go through and I would create little postcards and I would say, did you know that you can possibly drop your payment, your mortgage payment by $100 a month? If you want to find out, contact me at blah, 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 blah. And guess what ended up happening? People would call.
You get their new contact information, new phone
That's
numbers,
right.
and email addresses.
That's right. You get their information, because I guarantee you, Mr. Eugene, if you got a deal that says I can drop your mortgage by approximately $100 a month, what you gonna do? You're gonna call me, right? So it's a way to generate leads. It's a way to end up generating some leads to end up going around, because when people hear they can save $100 a month, they're gonna jump. That's $1,200 a year. Okay. Now, they of course also split or piggyback loans. It's also going to be required on in those particular situations. Now, when we deal with refinancing of conventional loans, now this is where real estate agents kind of get a little irked, because they're like, Stephan, you may talk to, say, Mr. Jacob and say, hey, Mr. Jacob, have you refinanced your loan? Interest rates are low. And you, of course, go over there, you talk to Mr. Jacob. Mr. Jacob's like, yeah, I'm going to do that. Well, do you think you make any money if Mr. Jacob refinances? No, you don't. You don't. But in the situation, though, here's the thing. It doesn't matter if you make money or not in that particular situation. No, not really, because why? If you save your client money, if Mr. Stephan, you call Mr. Jacob and you save him money, okay, is Mr. Jacob going to stay with you? Yeah, he is. He's going to stay with you. And if he's saving money, what can he now end up doing? He can buy more properties. And if he's buying more properties and you save your money, who's he going to use?
He's going to use you.
He's going to use you again. Okay? So in this situation is you want to keep in contact. You want to keep that going. While you may not make money as a real estate agent or in refinancing, it doesn't matter because your job is not always about making money. When I have real estate agents that their sole purpose or their sole intent is focused on always making money, they're the ones that often don't stay in real estate long. Because the fact is, their focus is on the wrong thing. Now, am I saying don't ever make money? No. What I'm saying is if Mr. Grossman, you talked to Mr. Jacob and you told him about that, you could say, well, have you happened to be looking at other properties? And if he says, no, I'm not looking at this time, okay. What do you say? Do you just give up there, Mr. Grossman? No, what should you say next? Well, do you happen to have any friends that might be looking to buy? Do you have any family member that's looking to buy? Because I really could use some referrals right now. Okay? Don't be afraid to put that part out there. A lot of agents, they just like, Ms. Davenport, would you like to go? Are you looking to buy? No, okay. I'm sorry. I didn't mean to upset you. I'm sorry. No. Most people are nice. Majority of people are nice. All you have to say is, okay, well, Ms. Davenport, can I just ask, do you happen to have a friend that might happen to be looking to buy or rent? I'd be more than happy to show them. Things like that, just asking, doesn't hurt. The worst she can say is what to me? What could you say, Ms. Davenport, if I asked, do you have friends or anything? No. Did I die?
That's so sad.
Yeah. No. It happens. Okay? No. But then what do you say? Well, Ms. Davenport, if you happen to have somebody, would you mind letting them know? And here's my card. That's it. Because let me tell you something. Most people feel bad because they're not able to help them. So what's she going to try to do? She's going to try to find somebody because I just saved her $100 a month. She's going to feel like she owes me something. So she's going to try to go over here and to drum up business. Okay? So you have somebody that's in your corner. Okay? That's one thing I have. One of my top producing agent for last year, Miss Linda, how did she make most of her money?
Oh, Lord.
Did she sit in the office and play on computers?
She went to at home. She went to Home Depot. You wouldn't imagine. Just struck up conversations with people she didn't even know. And she spoke to one lady at home. Yeah, at home, and she got the listing for $800,000.
Yep. See, the thing is, guys and gals, you have to get yourself out there. Now, Mr. Travis, does that work for everybody though? Does that type of technique work? No, and it's not something. That's why I always tell people in the situation. I'm not going to force something on you because here's the thing: if you're not comfortable with that type of method, what happens? You're going to fall. You're going to look bad.
Yeah.
You don't end up. That method may work for one person, but may not work for somebody else. You just got to find it. There's some people, they're good behind the phone. I might put Miss Davenport behind the phone and she can call people all day and that's her comfort zone.
And she can
And
have
she-
all the phone
And
calls.
she can have all the phone calls she wants, right?
Amen, brother. On
I got
that.
my phone too. I'll give you my phone.
Hey, there you go, Miss Linda. He'll give you a phone too.
Oh, no. Right?
So in that situation is, yes, there are these different benefits. But again, when coming into refinancing, there are these options that are shown on the screen. You do have your home affordable refinancing program. You do have your streamlined modification program. That's basically utilized that if a person does not or unable to pay, sometimes a person may not be able to get refinanced. Sometimes that person just has terrible credit, but they need to modify their loan. Yes, real estate agents, we can help people get their loans modified, okay? So there is the streamlined modified program. There's the home affordable modification program. It can reduce the rates as low as 2%, and it will extend the loan up to 40 years. So if you extend it out 40 years, what happens to payments? They drop, okay? You can also defer a portion of the principal until the loan's paid off, or you can elect to forgive your principal, okay? So there are these different programs that are out there. Now, we talked about this before in previous classes. The A, if we want to put grades on it, the A loan, the best loan, is called what, Mr. Eugene?
Subprime?
No, sir, not sub.
I mean, prime.
They're prime. They're prime loans. If they are prime loans, they're the best of the best, okay? So these two that are up here are not going to be classified as the best of the best. These are going to be your lower, your C students, your D students, your F students, okay? So in subprime, these are often going to be loans that are going to basically be for the people that have bad credit. The problem with these is they oftentimes have higher interest, extremely high fees, and they're also going to be based off of risk. They're also given a classification of either A, B, C, D, or paper. Okay? Again, not something that's beneficial. Now, when dealing with subprime, most national lenders are not going to touch this. They're not going to touch these. Why do you think they're not going to touch these?
They're gonna be more,
High
it's not
risk.
paying.
They're high risk of not paying. Okay?
Foreclosing.
So who do you think is going to lend to these people? Do you think Wells Fargo, Chase, any of them are going to lend to these people? Not likely. So who's going to lend to these people, do you think? Look behind you, Miss Linda.
Travis?
No, he's pointing at you.
Me? You remember, I owe you over $100,000.
You still owe me $150,000.
No, really, listen, well, no, you owe me 50, so I took 50 out, so you owe me 100.
He owes you, huh?
That's right. No, that's right.
But the whole thing that comes down here, hey, interest added on last time. So
I didn't agree.
how much is it now?
Yeah,
Million?
53%.
I didn't agree to know it.
I looked it up. You owe me $283,000.
There you go. But what happens here in this situation, guys and gals, is that it's going to be predatory. It's going to be not predators, but it's going to be predatory. Okay? It's going to be individuals that are going to be loan sharks. Y'all ever heard of those? That word. Loan sharks are going to be the ones that are going to lend to these people. They're going to be the individuals that are going to go over there and tell you, hey, Mr. Grossman, you got bad credit. I'll give you a loan, but at 25% interest. Okay? They set up situations where it's going to be unnecessary or unable for him to ever pay it back.
Impossible.
Okay? So it's unnecessary rates and fees. Loan flipping happens a lot in this situation. Inflated appraisals, high pressure sales tactics, and red flags are all going to be part of the subprime. They're going to be very high stakes and pushy. They're going to be like, no, Mr. Grossman, you don't want to leave yet. Sign this document, Mr. Grossman. You don't want to lose it. You walk out that door, Mr. Grossman, and we're going to go from 25% to 50%. You better sign right now, Mr. Grossman. Right now, Mr. Grossman. So in these situations, guys and gals, we have to look at these, and your clients will go in. If a client comes in and they have a subprime loan, you might want to have a talk with them. Okay? Not something that I recommend. Now, in regards to the variations in the formats, okay, in this particular situation, there are open-ended mortgages, okay, and these basically allow, in regards to the open-ended mortgage, it allows for future advances. They do cover personal property, and they're often used by farmers and builders. Now, let me explain here in this situation. Do you think, Miss Leela, I'm going to ask you a question, madam. Do you think, Miss Leela, that it is wise, in any way, shape, or form, do you think it's wise that you should put personal property into your mortgage?
No, I don't think it's wise.
Why do you say that, ma'am?
Because if something goes wrong, you're losing your property twice.
That's right. And also, if you're buying, and I can tell you this just from dealing with builders over my time, a lot of builders will literally go around, especially now, everybody's loving this antique. I love that word antique, but it's basically somebody's junk. Okay?
I'm sorry.
It's not.
I'm just telling you.
Yeah, it is.
What happens in most situations, no joke, I've seen builders do this. They will go to garage sales. They will find something, say Miss Elizabeth threw something out, a dresser out, okay? They'll find Miss Elizabeth's
And
dresser,
refurbish it.
and they will take it and they will refurbish it. But here's the thing. Miss Elizabeth, they probably paid her, say, $50, okay? They go refurbished it, what'd you say, Miss Elizabeth, another $50? Maybe 50, okay? So for another $50, $100 they put into this. They put it into the property, and guess what they put on it? $2,000. And they put $100 worth of work into it. Now, here's the problem. That's going in your loan. If you're at 5% interest, by the time you pay off that thing, that furniture, that $100 might have cost you $10,000. Do you see why it's not a wise idea to put personal property into a loan? Does that make sense? Okay. Understand, builders want to make money, but they also are not going to go. I've seen this too. I've seen where they've gone to IKEA. You know what IKEA is? How's the quality, Miss Elizabeth, in those IKEA products?
Swedish junk.
Yeah, Swedish junk. It's terrible stuff, right? So imagine, and I've seen this. I've seen them put IKEA furniture through an entire house, and they say, we're furnishing it, and we're only charging you, keyword, only charging you for all this furniture, $50,000. How much do you think they probably paid for that IKEA to furnish an entire place? Maybe 10, maybe 15?
Maybe 5.
Yeah, okay.
IKEA, yeah.
So in that situation, you got this property.
Swedish stuff.
That's right. You got this, like you said, designed Swedish,
Yeah.
custom, you know.
Exotic
Yeah,
European.
there you go, exotic European, okay? But that's how they're gonna sell it to you. But you pay that interest on that stuff, guess what? It's gonna cost you an arm and a leg. And I've dealt with lenders. I've had lenders before over my years, where these lenders go in, guys and gals, and they're good at it. They're good at it. They'll tell you, now, Miss Davenport, you know, how about you just do this, ma'am? You need the money right now. You've got $20,000 sitting in your bank account. How about we do this, Miss Davenport? We'll just put all that furniture in your note, and we'll just make it so simple for you, Miss Davenport. And you keep that $20,000 and you use that on yourself. Go buy you a nice car. Okay, that's how they're going to do it. You go buy that nice car. Well, the thing is the reason they did that is because they can increase the loan and they make more money. Okay, if you were to take it as blank, nothing in there, they lose money. So they want to make it seem like you're getting a good deal, and it's not a good deal. Okay. Construction mortgage. How construction works is it's dispersed by draws. Okay. So what happens is they send out money in draws. Okay. They give out money in portions. Okay. There is a standby commitment, however, that you will have financing. They're not going to just bag out in the middle of the transaction. You do and you will get your money, but they're going to be given at certain intervals in the building process. Okay. Now, there are different variations. We have many different variations that are here. We have blanket mortgage, leasehold mortgage, package mortgage, manufactured housing. All of these are different types of options that are here, different types of monetary funds in regards to how you can borrow money. Okay. The key thing here, and this is something I always tell people, you need to, when you're talking to a lender, what do they focus on, Mr. Eugene? Do they focus on the total amount repaid, or do they focus in regards to the monthly payments? Why do they focus on the monthly payments?
Get their money back, make sure that,
No, if I'm trying to sell you a loan,
sell me a loan.
if I'm selling you a loan, we end up in this situation, what ends up happening? I'm going to end up doing what? Do I want to show you the big debt you're going to be in?
No, you wanna make it nice for them.
I'm going to make it small. Mr. Eugene, looky right here. Yeah, I know you're getting a loan for $300,000, but Mr. Eugene, we're going to get you for $1,500 a month, sir. That's less than the rent in that area.
No.
You should really, Mr. Eugene. That's a good deal. No, don't look, Mr. Eugene, at the the $400,000, $600,000. Yeah, don't look at that. Let's look at this nice, and we'll even wrap in your personal property, that European custom furniture in the house too.
I got home for
And you only have this loan for 85 years.
Yes,
$1,500 a month.
$1,500 a month for the rest of your life. How's that sound, Mr. Eugene?
Worth a flip.
Yeah. Okay. So in that situation is you want to make certain that you're aware of these things. You need to ask these questions because, again, lenders are in the business to do what? Make money, just like everybody else is. It's not that they're bad people. It's the fact is, the more they can sell you, the more they make. Same thing in building and in real estate. The more I can sell you, what happens? The more I can make, okay? But again, you need to be aware of these different types of loans. That's why I always tell people. Now, let me ask you this. Travis, do you think that you need to, as an agent, need to know every single detail about every one of those? No. Whose job is that for?
That's yours.
No.
Yes, it is.
No.
That's the lenders.
That's Miss Leela's. That's Miss Leela's
Yes.
job. Y'all gotta remember.
Yes.
Oh,
Miss
it's
Leela's.
Miss Leela.
Always call her.
Call
Can
Miss
you
Leela.
give us your number real quick?
When 1-800 don't call me.
They're open 24/7. You just go on and call.
I'll pay you in enchiladas.
Oh, but no, the whole thing comes into this is, yes, the lender is the one that's responsible. And that's why, again, having somebody that you can call. Y'all, I call poor Jake and I call some other people. I literally get on the phone with my dad Saturday. It's a Saturday. And he's with his kids and all, and my dad says, I want to go in and, talk to him about, I got some questions. And I just literally was like, hey, let me just call him. What? Hey, Jake, my dad needs to talk to you. That's the kind of relationship you want to have with your lenders. You want to be able to have those so that if I'm sitting here and I'm talking to Miss Davenport has questions, she doesn't want to wait 2 days to talk to somebody. She wants me to end up, and she's definitely going to use me if I can be like, yeah, Miss Davenport, let me call him. Hey, Jake, Miss Davenport's got a question. Here you go. That's the type of relationship you want to have, okay? You need to know of these, but you don't need to know the specifics, okay? That's not your job. Now, again, we do have mortgage participation. Again, there are partnerships, and again, they're all broken down here on this slide for you. Again, there's many of them in regards to how we break these down in regards to partnerships with mortgagees, mortgagors, and again, partnerships between the parties together, and shared appreciation. Now, this is the one that I want to spend just a little bit of time on before we call class, because I know a lot of you are getting tired, but I want to go on and spend some time here on this one. There are tax impacts in regards to mortgage lending, okay? The key thing that you need to be aware of, and this is what you want to use as a real estate agent, very big, very important. You want to understand the capital gains. Okay, this is very big. So if there's anything that you learned from me tonight, this is it. So if you're sleeping, you're eating, here's the time to turn up the volume, listen to me, because these are the 2 points for you as real estate agents to get leads. Okay. Very first one. In installment sales, what happens is when you're making payments on a house, if, say, for example, Mr. Eugene and Miss Linda, y'all are married, y'all want to go buy a house. And instead of buying just a resale, you want to build. So, Mr. Eugene, you, Miss Linda, build a house. And y'all hire Miss Elizabeth, and she finds some land and all, and she builds a house for you. And ends up the situation, Miss Elizabeth charges you $300,000 for this house. That's the land, the house, and everything. You make your payments, you go in there, y'all are living in it, you're happy, and then all of a sudden, that $300,000 house has now ended up, it is a prime area, and it's now worth $800,000.
Sell.
Yes, that's right, sell, okay? So you want to sell, and it was in 5 years, it's jumped up that much. Okay, so now you want to sell it. Now, Mr. Eugene, if you sell it, what was your, and this is the key word, what was your cost in purchasing that property? What's your cost? How much did you pay for the house?
Been paying for the house.
What's your cost? What did you buy it from Miss Elizabeth for?
$300,000.
$300,000, that's your cost. Okay, so Miss Elizabeth, you paid her $300,000. So your cost in the house for IRS or tax purposes is they're going to base it off of that $300,000. Okay. Now, In that situation, Mr. Eugene, you paid 300,000, but you made how much?
500,000.
Well, no,
Well,
you sold it for 800, right?
right,
So you made how much?
well, what, 500 less whatever.
You made five. We'll just call it 500,000. So if you get a $500,000 check, that's your profit. How much in that situation, Mr. Eugene? My question now is to this: how much of that is taxed?
Oh, it's taxed, ain't it?
All of it's taxed.
Oh, wait a minute, capital gains, no,
You made 500,000 off of the sale of your house.
So you don't, it's not taxed, is it?
It is not taxed.
That's right.
You have capital gains
Yeah.
exclusion
Yeah.
up to $500,000 because you're married on your, here's the key word, your primary residence. So if in this situation, Mr. Keith decided he wants to sell his property, but it's an investment property, and it has gone up $500,000, how much can he walk away with? How much can he take an exclusion?
500,000, he's gonna have,
He made investment.
Minus capital gains tax.
Uh-huh. So the key thing here is he actually does not, he has to pay taxes on all of it because it's investment. So the key thing here is you got to be very careful in this. But when you talk to your clients, this is an option for you to tell your client, Mr. Grossman, what did I tell our client that we were talking to when he's buying? What was my biggest sell to him? To get him to finally focus and actually buy a house.
Equity.
Why is that such a big thing?
Because,
He's building what? He's building a savings basic.
building that,
He's making money.
maybe equity.
And if he builds equity and it's his primary residence, he gets tax benefits, which allows him to take that money and do what? Buy a bigger house and roll it into a bigger house and keep doing this. And eventually what happens? He can have a mansion and pay nothing. Okay. So again, in that situation, there are benefits in regards to the installment sale, in regards to selling, okay, in regards to making profit. Now, the other one is the 1031 exchange. This one I deal with a lot. And those of you that know me, I may even try to become a 1031 agent. But, but in the situation is, a 1031 specialist or a transaction is this. A client in some situations, say that Mr. Travis, that he has a house, that it just seems not to rent. He's done everything to it, taken care of it, but it just does not rent. Well, he finds another property that Mr. Garrett has, okay? And he says, Mr. Garrett, I want to basically sell my property and buy yours, okay? And Mr. Garrett says, okay, sounds good. I actually want to sell mine and buy another property for Mr. Colton, okay? So in this situation, what happens is if you do it for productive use, you're actually making money off of it, and the property, the key word is like kind, okay? Then what happens is you can roll over that money. So here's the key thing, guys and gals, and I'm not going to go into a lot of detail on it. You just need to be aware of it. When Mr. Travis sells his property for $200,000, okay, you sell it, Mr. Travis, for $200,000. You cannot put that money into your savings account. Can't put it in your checking account. That money has to go into a 1031 specialist. So Mr. Darren is the 1031 specialist. So he would then hold that money for you until you identify a property within 45 days, and you have to close within 6 months. And when it's done, Mr. Darren releases the money and ends up in that situation, pays for the new property. But your client can never touch that money. If that money touches, Travis, if it touches your account, your banking account, it is taxable, period. Okay? It's taxable. So you want to make certain that you're doing this perfectly set, because otherwise you can end up, it comes into what's called a boot. Okay? And in a boot, it is taxable. And you don't want to pay taxes at 35% on that property. Okay? So again, there are different types in these situations, but these are the different types of tax impacts that deals with the mortgage lending process. Okay? Do you need to know all the details on this? No. If a client wants to do a 1031 exchange, what do? Client needs to go talk to a 1031 designated representative and let that person set everything up. You never yourself do it. You can't do that. One time I heard somebody say, well, I'll just take the money and put it in my broker's escrow account. Nope. You have to be designated before you can do that. And you actually got to sign a bunch of paperwork with the IRS. Okay? All right. So that ends class for tonight. Let me go ahead and stop our recording.